Hello, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, August 10th, 2026. As we previewed last week, a number of economic data points that were released last week, but only one that really mattered. That was on Friday. We'll hit that at the end. But prior to that, we had some pretty decent economic data, I would say. Monday, ISM manufacturing, much better than expected, was expected to come in at 54, came in at 55.6. This is really kind of remarkable. I haven't seen a lot printed about this, but the renaissance or certainly the improvement of U.S. manufacturing, this index just 3 years ago was consistently running under 50, and that's the demarcation line between expansion and contraction. And at that same time, the ISM services number was in the mid-50s. So we would always point to services pulling the economy through, manufacturing being a drag. But that seems to have flipped around, or certainly the improvement in manufacturing is coming through in this metric, the PMI at that 55.6. Also last week, jobs openings, the JOLTS, that came in better than expected. Consensus was only for 7.25 million job openings. Came in closer to 7.4. Good. Factory orders, a little bit light. So that is one negative point for June. Came in month over month at negative 0.3. It was expected to be up 0.5%. Not a big deal. The next day, though, the ISM services, just referenced that, as it was expected to come in at 54.2 and sort of did, 54.1. So both manufacturing services pretty solid at this point. Initial jobless claims, we've just mentioned the fact that this keeps coming in better than expected. A handful of weeks now, less than 200,000. We haven't been at these levels in, I think it's 20 years. It is pretty amazing. So last week, 199,000. Expectation was 200,000, so we'll call it in line. But then on Friday, the big event, non-farm payrolls, and the expectation, we show here the consensus of 91. I saw people walking that back just before the release, and sure enough, it came in weaker than expected, much weaker than expected, negative 23,000. So at the same time, unemployment rate, you might have expected to go up. That actually went down. Participation rate was down is the answer there. But unemployment rate dropped from 4.3 to 4.1. Good. But non-farm payroll, jobs added, negative 23,000. The prior 2 months also adjusted downward. So it's hard to make out this picture, but clearly we have been mentioning, many pundits have, that employers right now are very reluctant to both fire and to hire. Certainly in this vein, that looks correct. The initial jobless claim numbers continue to be low, but so do the new jobs added in total. We show here also average hourly earnings. That was expected to come in at 0.3, came in at 0.1. So what this does in terms of setup, investors are very concerned about inflation, and by itself, they're concerned about it, but really investors are really concerned about it because of what it means for interest rates and the direction. So the non-farm payroll, obviously the headline number you would think not great, but actually it helps investors, or at least helps investors think the possibility of interest rate hikes are diminished from what they were previously. So we look at the inflation expectations. I think this speaks to it. A week ago, the 10-year break-even was at 2.28. We had that bad jobs number, and the 10-year break-even actually dropped to 2.25%, 3 basis points. Still significant, and I would point to this chart and just take a look at how seldom we've been at this low of a level of expectation for inflation over the next 10 years. This goes back to 2021, so it does include that 9% CPI number that we had March, April, June, whatever it was, of 2022. But point is, expectations for inflation are pretty muted for the next 10 years. Now, here's a chart that is hard to explain. The Atlanta Federal Reserve expects third quarter GDP to come in at 5.8. Last quarter, I think, was 1.6. First quarter was 2.1%. So this looks like a complete outlier. And I think as we go through the quarter, we update this almost every week. We're guessing this is going to come down. What is driving this is the AI spend. So investment in total has really ramped up. AI driving that's part of it. Also, consumer spending has been resilient / strong. So GDP growth in the third quarter may accelerate, but going from 1.6 in the second quarter to 5.8 seems a little high. We'll see. In terms of the Fed funds, and this is a very key one, mentioning the fact that the jobs number negative, but it sort of positive, at least for the markets. The expectation for Fed rate hikes in September during the September meeting, last week that was 72%. It dropped to 44%. And then by the end of the year, the odds of no cuts or no hikes either, 23%. That's up considerably over the last 2 weeks. There's a 45% probability of one rate hike. Now, that went up week over week because the other categories went down. Now, there's only a 27% odd of two hikes. A week ago, that was 42%. And now only a 5% odd of three or more rate hikes. Just last week, that was 12%. So, lastly, in terms of last week and all the economic activity, we'll just mention corporate earnings. We're at the end of the cycle, S&P 500. 88% of companies have reported. 86 have beat consensus estimates. That's way above the 5-year average, way above the 10-year average. And the magnitude that they've beaten by is silly, so I won't even mention it because it's elevated by both Alphabet or Google and Amazon taking gains on SpaceX and Anthropic Holdings, respectively. But if we strip away that number, this is still pretty amazing. Strip away those two data points, S&P 500 companies have beat on average by almost 11% during the second quarter earnings cycle. That's just way over 5-10-year average, any averages. Super strong. So even if we took out Amazon and Alphabet in terms of the Q2 earnings growth, including them, it's 50.4%. Seems pretty ridiculous year over year. But we strip those out, it is still 32%. So those questioning how the equity markets continue to work despite all kinds of craziness everywhere else, this is absolutely the answer, and it is it's just super impressive. Revenue growth. So this oftentimes we'll see good EPS growth from S&P 500 companies, and the market kind of yawns. Sometimes because it's margin, and they expect that companies can't take margin forever. True. But what is driving this earnings growth has been revenue growth. 76% of those S&P 500 companies that have reported, they beat on revenue growth, and in aggregate, it's 3.2% revenue growth above what expectations were. And year over year, the blended revenue growth for the S&P 500 companies that have reported, 88%, is 15%. That is really, really strong. So how did the markets react to this news last week? U.S. equities, another one of the strongest weeks we've had in some time. S&P 500 up 3.6%, Mag 7 up 4.5%, U.S. growth up 6.6%. So now on a year-to-date basis, S&P 500, it's pretty impressive, up 14%, and the equal-weighted S&P, signifying that we've had some broadening of the market, up nearly 16%. And Mag 7, as previously mentioned, I'll just say year-to-date, up only 5%. So it's the other 493 driving the returns in the S&P 500 this year. Last week, international developed markets ex-US, good week, not nearly as good as the S&P, but up 2.4%. So now the S&P 500 is in line, almost the exact same return as developed markets ex-US. Now, emerging markets Still a sizable lead in terms of performance year to date, up 19.5%, but a tough week last week for emerging markets, down 43 basis points. Fixed income, very strong rally last week. Now, if you watched last week's version, I told you the opposite. Fixed income got crushed 2 weeks ago. Last week, very nice rebound. Again, it's because of those inflation expectations coming down and the expectations for the Fed rate increases coming down. So the 2-year yield last week positive, down 10 basis points positive, and the 10-year down 9 basis points. So the Bloomberg U.S. Aggregate Bond Index up 60 basis points, which takes the year-to-date return almost to flat. This week, we'll take a look very quickly at the economic activity that will be reported. Tomorrow we have existing home sales that won't move the market, expected to be down slightly in July from what we saw in June. The big day or the big moment will be, or one of the two really, inflation numbers is on Wednesday. We'll get CPI, we'll get headline number and core number. So the headline number is expected for July to be up 0.1. For the month of June, that was actually down 0.4 and was a surprise. But the core inflation, taking out food and energy in terms of month over month, for the month of July is expected to be up 2.2%. And for the month of June, that was flat month over month. So looks like accelerating inflation in this case. On Thursday, initial jobless claims, consensus coming down to where we were last week, 198,000. But the other key inflation number comes on Thursday, and that is the PPI and core PPI number. So for the month of July, month over month, PPI expected to be positive 0.1. The month of June, it was a negative 0.3. And then the core number is expected to be up 0.2% month over month, same as we had in June. So lastly, on Friday, we'll have retail sales and retail sales ex auto. Retail sales for the month of July are expected to be up 0.1%. In June, they were up a little more, 0.2%. And when we strip out autos for the month of July, expected to be up 0.2%. But in the month of June, they were down 0.2%. So that's it for our economic wrap-up. We thank you very much for joining us, and we hope you will join us next week. Thank you.